Stan, thank you so much. And again, I encourage you to participate in those kits, and let's get that goal accomplished today. Following our keynote conversation, our first panel discussion is going to focus now on managing the economic and social risks of climate change and help us understand the financial and equity challenges of climate risk. Moderating this conversation is the Executive Director of the Institute's Griffith Insurance Education Foundation. Please welcome Frank Tomasello and our panelists for today's conversation. Thank you.
Thanks.
All the way down.
Well, thank you, Connor, for the introduction, and also our thanks to Susan Winkler of CTIFS, to Commissioner Mays of the Connecticut Department of Insurance and their respective teams for inviting us to take part in these important conversations today. The urgency around climate risk and insurance market stability is accelerating. Some would describe this as a period of unprecedented stress. Challenges related to availability, related to affordability abound. But with those challenges come opportunities. And in the 60 minutes ahead here, in the insurance capital of the universe, to quote a certain individual present in the audience, we will explore opportunities to address those challenges. Joining me in discussion are distinguished thought leaders from across the insurance ecosystem. Please, let's welcome Eric Nelson to my immediate left, to your right, the Senior Vice President of Enterprise Catastrophe Risk Management at Travelers. Ms. Amy Bach, Executive Director, co-founder of United Policyholders. Also with us on the panel today, Mr. Roy Wright, President and CEO of Insurance Institute for Building and Home Safety. With us today as well, former Executive Deputy Superintendent for Insurance at the New York State Department of Financial Services, Bhavna Agnihotri. Thank you for being with us. And last but not least, Mr. Bryan Garcia, President and CEO of Connecticut Green Bank. Thank you so much, panelists. Look forward to the conversation. To get things started, I would appreciate a bit of a level set, perhaps for some members in our audience, and ask if we could take a step back and obtain your thoughts on today's climate risk landscape. Are the climate risk threats of today unprecedented? Can you help sort of set the table for us? And perhaps, Roy, if I may call upon you to kick us off, that'd be great.
You know, you look across the set of perils that hit us in the Nat Cat kind of space, and clear correlation on the flooding, the Atlantic hurricane risk, wildfire side of the equation, and those elements that are in play. I do think that we have seen this evolution in that space where we have consumers who otherwise didn't have to think about this, having Mother Nature come through their front door. And when that happens, driven by severity and frequency elements, it causes a reckoning. And I want to make sure that we're clear that as we look at these elements, climate attribution clearly has a connection on that flooding, on the hurricane, on the wildfire side of the equation. It's not as clear of a connection when we deal with severe convective storms. Somewhat related, but a couple paces of removal in that. Yet that part of the country is experiencing what they perceive as the same phenomena, which is, but I've got events and I've got expenses that are here. And so I think there's two things that are happening at the same time in the country. Different geographies experience it in different ways. Some of that is climate driven, and some of it is we've built more structures in harm's way. Those two pieces are coming together. I think for consumers, they rarely untangle the two. I think amongst the experts, we can nuance those pieces. There frankly are different strategies based on those two pieces, but I think both of those are in play as we have conversations about the climate drivers.
Thank you, Roy. Anyone care to add any color there?
I was just going to add a little bit more detail there as the insurance guy on the panel. So if you think about climate risk in the insurance industry, we call it catastrophe risk. And you look at catastrophe risk losses that have occurred over the last decade, over this decade that we're expecting right now, it's going to amount to about $1 trillion in catastrophe losses. That's a big number. That has doubled in the last 20 years, doubled. So you think, what's driving that? And I want to just put this in perspective. Inflation, inflation, inflation is the number one issue. And I'm not talking about anything with tariffs and everything else that might happen right now. It's over the last 3 or 4 years where building and labor materials have gone up significantly. When you think about insurance claims, it's mostly about the roof. And so inflation is run for building materials about 10% that we've seen, loss trend we call it. In addition to that, Roy mentioned where you build. Where you build is so critical. Connecticut, we're not building a lot of new houses, a lot of new neighborhoods, but when you go down south in Florida, think about where you build and where you build close to the coast. Well, that might have accounted for, say, 3 to 5% annual increase because we're building in harm's way. And then climate, Roy talked about climate already, but I'm just going to give you numbers to give you a perspective. Karen Clark and Company is an expert modeling firm. They have a paper out on climate change. And they've put the scenarios at probably about a 1 to 3% annual increase in losses due to changing climate conditions. As Roy said, worse for wildfire, a lot worse for wildfire, for flood. There's indications for hurricane. Less so, the science is out on SCS, tornado hail, and some of the other perils. So that just shows you, but I want to add one more comment. Where you build is so critical. We did some analysis looking at the hills in California, and you think about low risk versus high risk in California, that's 10x the risk. So if you're paying $1,000 for insurance in a low risk area, and you build in those hills in a high risk area, you're facing a $10,000 premium. It's 10x the risk. So where we build is critical part of this dialogue.
So my organization has been working to help the consumer adapt to the way the insurance industry is adapting to the new normal. We heard a lot of interesting comments in the first panel, including Commissioner Mays saying, well, you may not believe in climate change, but your insurance company sure does. That's a really profound recognition of what is so unprecedented about what's happening is that for consumers, they are starting to be forced to think about insurance a lot more than they had been, to pay more, but also to think about the fact that they have risks and that they can't, it's not just some automatic thing where you give the insurance company money and all your risk is gone. It's not like that. It maybe never was, but it's not like that at all now. So while things are unprecedented, and I think consumers are behind in terms of really grasping what's happening, one of the phenomena that is unprecedented is the impact on the reduced competition, reduced appetite for insurers to compete in certain areas, and then this explosion in technology, including the predictive modeling that Karen Clark and her colleagues are doing, the aerial images that insurers are now using in place of traditional underwriting approaches, and basically what I often call the TMI that insurers have about risk that is really causing some seismic shifts in what they're charging, and then of course this growing swath of Americans that don't have a mortgage and are opting to go bare because they just can't, either they can't stomach the premium or they just think it's not worth it.
Thank you, Amy. Bhavna, Bryan, anything to add there?
I would just talk a little bit about the ripple effects, right? So we're seeing these increased frequency and severity of events, right? And they cause ripple effects. Yes, they cause these insurance costs, but then they also cause increased first responder costs, right? There's the debris removal and the cost to local governments to doing all of that. There's the supply chain costs. For example, in Mississippi, when there was flooding, $1 million of grain was just sitting there, right? So that disrupts the entire market for the grain. And also we're seeing insurance deserts, right? So in California and the wildfire areas, in Louisiana and Texas, in coastal areas in Florida, there are many areas where we're seeing insurance deserts. And when you see that, an insurance desert is when there's no insurance available, right? So then people go into the risk pools, and the cost is not just the risk pool is picking it up and providing less coverage for the consumer, but it's also the ripple effect on the property value, right? If you're not able to buy insurance, your mortgage is not going to be approved. So therefore, there's less demand, and it has this rippling effect. So we need to look at the, to the gentleman from the Fed's point earlier, let's look at it a little bit wider and think about the ripple effects.
I guess what I would add is I'm not sure what the legal or scientific definition is of existential threat, but I think the governor and the commissioners alluded to it earlier in the severe storm we experienced here in Connecticut in Naugatuck Valley. I mean, when you have 14 inches of rain coming down in a number of hours that was unpredicted, that is a 1 in 1,000 year thing, 1/10%. I feel like that's biblical. I don't know how the insurance industry thinks about those sorts of dates, but the existential threats are there, and they're coming in a variety of different ways, whether we can predict them or not. The conditions are going to come together, and we're going to experience more and more of these sorts of events.
Thank you, panelists. Appreciate your thoughts on the threat landscape today. And you spoke a little bit to this, but to drill down perhaps maybe a bit more deeply, how would you describe or how do you view the current state of domestic insurance markets in the U.S.? Obviously, we sort of talked to that a little bit, but care to share any thoughts there? Amy?
Sure, I'll start. Certainly, all eyes have been on Florida for many, many years. A lot of people peg some of the problems in the Florida market, property and casualty market, to Hurricane Andrew back in '92, where that was kind of a wake-up call, I think, for insurers in terms of the dollars that were involved. And since then, it's been a succession, and you can see a lot of the experiments that Florida has been doing in this sort of interface between government and private sector. You see the public hurricane model in Florida, which now California is going to be emulating. You see the Florida Hurricane Cap Fund, reinsurance facility that there's a lot of discussion in other states on can we do that. And so, I remember in the early years, United Policyholders is based in California. In the early years, I'd say like 2016, when we started seeing the non-renewals coming faster and not seeing competition filling in, where one carrier non-renewed, we were not seeing as much enthusiasm among their competing companies to fill in. And that's when we started to see the FAIR Plan growing. So I think, and originally I remember our commissioner saying, Amy, please don't use the word crisis because we don't want to stir a panic. And I do think that there is a lot of panic. I think there's a lot of media coverage of what's happening with insurance. And there's a lot of journalists who are just dipping their toes in the insurance waters and making some pretty scary, predictions. But I do think that, in a lot of the states, from what I hear from regulators, that things they're not as dire in a lot of states, but that we do have some exemplar states where, we have some insurance deserts. And that's primarily in Florida, right? High property values, high density state, similar situation in California. But there's lots of areas, including Long Island, in New York, where there aren't a whole lot of options. There's 1 or 2 options. So yeah, things are dramatically different, but maybe a little more manageable than you might think from reading the headlines.
Thank you, Amy. Panelists, any other thoughts there? Anything to add?
Yeah, I would just add a couple other, I think you said it well earlier. The question is, I don't like the word insurance desert because I think you can find coverage. The question is, at what price? My parents have a place down in Fort Lauderdale, and you'd think right on close to a mile to the beach, I'd have a problem. I found coverage. I did not like the price, but I found the coverage. And so that's, there is a cost to living close to the beach, I try and explain to my parents. And so I think we do have to step back. We have a day of reckoning coming in certain ways. Think about the NFIP program. NFIP program by the federal government, in my opinion, rates are at least subsidized by 50%, right? And we already think that the flood rates are expensive, but if that were in the private market, it would be much different. What's happened with those subsidized rates? Insurance is supposed to be a risk signal, right? That's the core tenet of insurance. We spread risk over people and over time, and it should be a risk signal. By subsidizing the rates, well, we've sent a signal to those consumers, right? It's terrible now, right? Now they're faced with even this risk rating 2.0 where they're starting to get the rates more towards actuarial sound, and they're facing sticker shock. And so we have to think about, as we suppress rates in some states, how does that create an availability crisis? And is there better ways to think about affordability? When I worked with Wharton School of Business years ago, they said, boy, we want the right risk signals, but we have to recognize there's an affordability gap. Should there be a mechanism outside of insurance premium, an insurance voucher, or some other mechanism to help those in need? And that's what we have to think about. We have to think about the unintended consequences of allowing unfettered growth with the wrong risk signals.
Yeah, I think one other dimension, inside a room like this, the terms availability and affordability come with full understanding and meaning. I think for consumers, those sound like code words that they don't quite get. What they experience is they don't have a choice in terms of who their insurer is going to be. They don't feel like they can go out and just get who they want. And I think in that case, again, a term we know in this room, but the E&S market is becoming more mainstream. Not something that would have been discussed 10 years ago. And so that point that goes, there's a price, whether or not that is affordable, whether or not they want to pay it, but it's become a place where a really complex set of industry dynamics that have long lived in conference rooms like this are now setting in communities. And particularly for the 5 or 6 states where the availability piece is now front and center, they're learning all these new terms, and maybe they should be headed towards the E&S market, but they don't understand what it is. It doesn't come with the same kind of protections and the like that are in place. They don't even understand why there is a difference. Yeah. And I think whether it's work that Policyholders or others are doing in that space, consumers, I think, are really left confused about what to do. We'll turn to the resilience side of the equation, but I really got to double down on understanding that insurance context, because we'll say, hey, there's a way to reduce your risk, and that will meet the product that you're buying, yet they're still struggling with the fundamentals of the morass that has become the product that they're trying to understand. We says, oh, put a better roof on. Oh, do defensible space, do this. And they're like, yeah, but what does that do to my product, to my price? I don't understand.
Thank you, Roy. Consumer education is a topic I would like to explore here in the minutes ahead. But before we do that, on the topic of availability and affordability that Eric sort of cracked open for us, I'm curious, what can we learn from both present and past efforts that are underway in the various states to address those challenges? History, I think, can be a valuable teacher. Bhavna, do you care to maybe share some insight there?
Sure. So I want to talk about 3 different states that we've seen address these issues. One, Alabama, which I think one of the panels earlier talked about, the Strengthening Homes in Alabama Act. That's a grant mechanism that gives grants to people in Alabama to fortify their homes to the IBHS standards. And it's really, the DOI, as Commissioner Mays referred to earlier, has just taken out a report, and it's shown to be extremely effective. So the homes in Alabama that were fortified post-Hurricane Sally performed 50% better than homes in a similar code. So what does that mean in terms of dollars and cents? So Alabama, in the entire time that this program has been in existence, has put in $86 million into the program, right? So $86 million is your cost benefit, is your cost. What's the benefit? How many of you think, we're gonna do an audience poll quickly. How many of you think we got the $86 million back?
Yeah.
One, really, guys? All right. How many of you think we 1.5 times that? Okay, a couple more. No audience participation here. The reality is we almost doubled it, right? So insurers saved 75% of the losses they would have spent. So they saved 75% or $112 million. That's a lot of money, a lot more than the 86. And then policyholders, by not having to pay deductibles because their homes were fortified, they did not incur losses, and that saved another $35 million. So that we're almost at 150 there, right? So almost double. That's a lot of money. And to my earlier point, think about the ripple effects, right? So debris didn't have to be removed, first responders didn't have to come in, people can go to school, people can stay in their homes, people can go to work, businesses are open, and the GDP ripple effects are significant. The Chamber of Commerce recently, I just want to highlight the ripple effects and quantify them. The Chamber of Commerce recently issued a report, and they said $1 of mitigation, just $1, gives you $13 in savings of losses, right? So insurance companies pay $13 less losses. And then on a broader GDP level, right, economic value, you're saving $33 worth of economic value. And that's, again, people staying in their homes, people being able to stay in their businesses, businesses remaining to be open, all of that ripple effect, the healthcare costs. So $1, 13, and then 33. That's called return on investment, right? And we're seeing states, other states like New York, like Connecticut, California, North Carolina, doing different things in terms of mitigation and having different programs such as this to encourage and provide grants to their homeowners. I just wanted to highlight Alabama because of the recent reports showing the clear cost benefit. Second thing I wanted to talk about is North Carolina. So I think one of the earlier panels was talking about these resilient bonds and resilient financing. North Carolina is an excellent example of this. They recently issued a catastrophe bond. And let me take a step back and talk about what a catastrophe bond is. Catastrophe bond is, it's a capital markets instrument where investors can buy a bond, right? And if it has really high, low risk of being triggered, right? So for like maybe a 1 to 3% risk of actually losing your money on the bond. And it basically pays out when there's a high number of losses. So let's say there's this huge Hurricane Sandy, Superstorm Sandy type event. If that happens in the next year, then investors lose their money, right? So this is a normal thing. The insurance markets have been doing this for some time. The interesting thing about the North Carolina bond is it added a 35 basis point spread called a resilience interest spread. And that is such a beautiful creative financing mechanism because if losses are below the threshold for that interest spread, which is below the loss trigger, North Carolina gets the money, right? And North Carolina's Insurance Underwriting Association uses that money to fund the fortified homes, right? So it builds it in. It's great for investors because they're presumably going to buy the bond in future years. They're also immediately getting that extra 35 basis points because if that loss level is triggered, so even if it's between, that one is at a 60% threshold. So if it's between 60 and 100% of losses that would trigger the bond, the investors get that 35 basis points. So even if they don't lose the money on the bond, they have the potential of getting that upside. So, and plus it has all the features and the benefits of having a resilient bond, right? So they get all kinds of credits in terms of their investments, logic, right? So that's the second one. Love it. Third one is nature-based solutions. And nature-based solutions are just that, solutions that are based in nature. So improving the viability of coral reefs, improving mangroves, and these nature-based solutions have significant benefits in terms of mitigation. In fact, they're seen to be even more effective than fortifying homes with the roofs and things like that, because your dollar just goes a lot further. And we're seeing communities do this. So there was, Mexico started it with the coral reefs, and the Mexico Coastal Management Trust issued a catastrophe bond where Mexico essentially would get paid out if their wind speed hit a certain trigger, right? So there are certain parametric solutions where instead of having to prove your losses, it's triggered on a certain level of, definable, easily definable trigger, like wind speed or earthquake level on the Richter scale, et cetera. So Mexico said, Mexico got the benefit of this, and they were able to put money into the coral reefs. Now you think coral reefs, they're great for diving, great, maybe some fishes are saved. You think of it as some, tourism industry would be saved. You don't realize the level of it, level of mitigation that happens. In fact, coral reefs can absorb up to 97% of wave energy. So think about that when your tsunami is about to hit you, right? Mm-hmm. Think about that when there's just general storm surge, right? That's a lot of savings. And these nature-based solutions can really provide that. And we're seeing it in terms of the US, we're seeing Hawaii implement this. And since 2022, the Nature Conservancy has been buying these bonds for Hawaii, and they expanded it even further in 2024. So these are just 3 examples.
Bhavna, thank you. All very positive examples, which is encouraging. Anyone care to sort of add any gloss on what she shared?
Sure.
Amy?
Sure. So we have some great progress, as you just heard, some of those examples in South Carolina, Alabama, and Louisiana, trying to figure out how much money can be allocated from the state towards the cost of helping households and communities and businesses implement risk reduction, improve property improvements. But I think where we are really, and for hurricane, there's some really fairly cost-effective, straightforward methods, right? Strapping and all that. The more challenging flood, obviously elevating homes, very expensive. So that remains a challenge, as well as the aesthetics for people. In California, there are many stakeholders that are hard at work trying to take lessons from other states and as quickly as we can spread the information. IBHS's Wildfire Prepared Home base and plus the issuance of those standards has been a big leap forward, as have the sort of the companion standards that the Department of Insurance put out to tell people, okay, these are the things that you can do. Where we really have a challenge now, and I think there's just a lot of dynamic struggle, is aligning the incentives for the consumer so that there's an assurance, if I do spend this money and I do uglify my property, I'm gonna get rewarded. I'm gonna get rewarded, and that's the rub, because I think insurers are still very much looking for a lot more evidence of the efficacy, for example, of wildfire risk reduction. And there is a lot of kind of political tug of war of, elected officials wanting to mandate discounts, but insurers saying, don't mandate until there's scientific proof of the reduction value. And then you have something that my friend Roy and I spent some time discussing earlier, which is people's real kind of deep attachment to what they have and what is, and a feeling that if you're going to make me do these things, it better dang well be worth it for me, and I better not lose my insurance after I've taken down my favorite tree and killed my grandmother's rose bushes. And that's really, I think,
Transplant
yeah.
rose.
Okay. So I think that's, I would say, one of our biggest challenges, in addition to, if you go to the NEIC meetings, you'll know at the last NEIC meeting, a group of my consumer advocate colleagues and I did a presentation, don't tell me to read my policy because it's kind of empty, since a lot of people really do have a hard time understanding where their holes are going to be, where their gaps are going to be, and what they can rely on, and that causes a lot of frustration and anger.
Yeah, I think that, let's take both of those perils. Let's take the harder one and then the one that I think has a clearer path already. On the wildfire space, it is both what you do at your parcel and your neighborhood. Unlike any of the other catastrophe-driven perils, it is about collective action, not just individuals. Yes, we need to incentivize people to start to be the leader in their community, and then your adjacent properties matter. This is not true in wind. This is not true in flood. You can have done the right thing and you're fine. In wildfire, it is that collective piece. And as we look at these elements, the willingness of people to take those actions. And in the California market, they do get price considerations when they do that. But if you get $300 a year, but you spent $4,000 taking the action, you start, well, the premiums didn't pay me back. No one actually told you that it was going to pay you back. But there are some consumer pieces. What is farther along and more mature is on the roof side with Fortified. And wonderful job laying out that piece from Alabama. It is interesting to me. We were out in California, and Commissioner Fowler from Alabama had flown out at the invitation of Commissioner Lara in California. This interesting bromance between two guys who stereotypically fit in their context, but don't really belong together very much. And when Commissioner Lara introduced Commissioner Fowler at a state Senate meeting, hearing, he goes, there's not a whole lot that we say we should do like Alabama, but they're doing this right. But the Alabama context has some layers to it, because as much progress has been made, the grants are important. The grants are only responsible for 17% of the designations in the state. The market has made that standard normal. And I do think this is a place where bridging, where capital comes in, how we can actually meet people in this element. I'm a fan of these grant programs, and they don't win on their own. Right. It's that point by which the building code reinforces it. The builders and roofers change what they are normally selling in such a way that it becomes the default. And that's when we really do see the rising tide help that play collectively and save tens and hundreds of millions of dollars, so that insurers are like, I'll take more of that. But I do think as other states come along in this space, sometimes they focus just on the grant program, or they focus just on the discount piece. I tell them, I'm like, those are true, and the building and contractors came along, and they changed the default code. All four of those are true, and collectively, that has produced. We will get there on wildfire. We are not there today. Yeah. We are very early in this pathway on the wildfire side of the equation. It brings other complexities. And even when folks are told you may lose your insurance if you don't change the landscaping outside of your front window, they'll tell you, let's see. And they'll gamble with it. And then when they get sent to the FAIR plan, the insurer of last resort, the residual market, they beg to come back. Because at that point, they're like, that's not great coverage, is it?
Thank you, Roy. I'd like to drill down a little bit on opportunities for economic incentives to drive mitigation. And I think on the other side of that coin, perhaps this notion of maybe mitigation creating economic value as well. And I think Roy was getting to a bit of that in his comments. Bryan, would you like to kind of jump into the fray there?
Yeah. I feel like Roy was talking about in the public policy parlance, market transformation, right? We really want to get to the private sector investing, because that's where we get to scale. So I wanted to talk a little bit about how events, climate-related events, lead to a public policy response, how a public policy response can lead to private capital mobilization to help us get to community resilience that we're after. So I want to give a few instances here in Connecticut as to how that has played out over time. In August of 2020, many of you here who reside in Connecticut experienced Tropical Storm Isaias. Many of you may recall that some over 700,000 residents here in the state lost power. Not for a couple of hours, not for a couple of days, but for a week, maybe more. I'm a former Peace Corps volunteer who served in the Republic of Kazakhstan. I could tell you a day or two without power was pretty difficult, because you not only didn't have power, you didn't have heat during the middle of winter. That was a super difficult time. But this is the sort of stuff that just shouldn't happen in our country, right? So it was a difficult time. The legislature came back into special session that fall because of this instance, and passed a really foundational public policy, Public Act 20-05, colloquially known as the Take Back Our Grid Act. It had a lot of really fundamental resilience public policy aspects to it. Several of them are definitional. One is around resilience. What is it? Preparing for, responding to, recovering from, human-induced, climate-induced, all these different sorts of impacts. So it defined resilience over a period of time. It also importantly defined, as the Federal Reserve Bank David was talking about earlier, a really important definition on vulnerable communities, and expressed a priority, as we heard the commissioners talk about, in terms of ensuring that vulnerable communities are taken care of, and included CRA eligible communities, the Community Reinvestment Act eligible communities, which really refers to less than 80% area median income census tracts in our state. So those two definitions came out of that act. Then the legislature came back into the regular session next year in 2021 and passed really progressive, really ambitious climate policies. One was a battery storage policy, establishing 1,000 megawatts of battery storage in our state so that we could ensure that families and businesses have backup for when the grid goes down. But the second thing was, and the governor led this, the governor has a council on climate change, and there was a report released in January of 2021 that included the expansion of the Green Bank's mission beyond clean energy to include environmental infrastructure. So we could now enable private investment in land conservation, parks and recreation, water, waste and recycling, agriculture, climate adaptation and resilience, you name it. The really key aspect, I think, of that bill was we now have the ability to issue a 50-year bond, which is a super power. We have yet to figure out how it's going to roll out or play, but those policies passed. As a result, our financing programs, we now allow our Smart E-Loan, which is for families who own their home, single family, to take out a loan through their local community bank and credit union. And the Green Bank supports with the loss reserve those local lenders to provide capital to families. We've been doing this now for over a decade. Over $175 million of capital has come from those lenders, not the Green Bank. We have only had to pay $75,000 in losses to support those loans from those lenders. So we want the private sector to help us achieve our public policy objectives. I could tell you, Sonia, Rob, Commissioner, our board approved of the fortified measure as an eligible Smart E-Loan measure going forward. They just did that recently. So we want to see more fortified roofs going into our homes here in the state of Connecticut. It was great, George, to hear the First Street. It's a great tool. I just went on, looked at my house, and know that I have a wind problem. So wind is a good fortified measure. So we need to be thinking about education and outreach across the board. We also, our commercial property assessed clean energy policy, we heard earlier from Nuveen, now beyond clean energy allows resilience measures to be supported through this benefit assessment financing structure here in Connecticut. As a result of Nuveen, of the Green Bank, and a number of other financial institutions, we've enabled nearly 500 businesses to receive over $400 million of investment in their properties on clean energy. We want to see that happen on resilience. So then coming back to the more recent event that we've been talking about, the severe storm in August of 2024, well, what happened in the next legislative session? We had Public Act 25-33 that passed, which the governor was speaking about flood disclosures, a lot of things around community planning, but it also included resiliency improvement districts. I'm going to follow Bhavna here and see if there are any folks here in this audience who are going to raise their hand. How many of you are familiar with a public finance tool called tax increment financing? Okay, I do. Okay, so there's some, probably 5% there, 10%. I wouldn't have expected it. Last night, we were at an event of municipal officials, and probably 50% of them raised their hand. So TIFs are a way for our local municipalities to support their economic development by using a benefit assessment structure to finance local economic development improvements. Well, as they do that, we want them to have this climate intuition so that they can begin to build into that risk mitigation so that not only are we supporting economic development and growth in our communities, but we're ensuring their resilience to the impacts of climate change. So as a part of this policy, we have resilient improvement districts, which allow municipalities to establish certain borders around certain taxpayers who can support resilience improvement projects and all pay for that through a benefit assessment, which is done for sewers, sidewalks. It's a tried and true way for local members of a community to pay for important public infrastructure. One of the innovations of the policy, we think, and we're still trying to figure it out, is the increased savings provision within this policy, which says that if you are in a resilience improvement district and projects for resilience have happened and occurred, then all of those policy holders, all of those families and businesses who are paying premiums to insurers are now better off. So therefore, their insurance premium should come down. So there should be some discount for them, and or those increased savings should go towards paying for the resilience improvements that happened to ensure that resilience, maybe covering the operations and maintenance of those facilities and the like. So we're really working to find ways for this increased savings definition to allow for enabling more private investment in resilience projects in our communities here in Connecticut.
Bryan, thank you. Some great examples of the private sector help there. I'd love to sort of transition and think through the regulatory lens a little bit about sort of how insurance commissioners and directors are aligning economic and mitigation goals. But before I do that, given all that you covered, anyone care to offer any color on what Bryan has shared or anything to add there?
Connecticut leads in this space. And as I travel across the country, the kind of examples that were just spoken about here, the kind of pieces that Commissioner Mays has done over a decade or so in motion in this space are the kinds of things that other states just keep looking to and how they can emulate it. And so for the rest of the country, can you hurry up?
Thank you. Bhavna, can I call upon you sort of to give us some perspective through the regulatory lens here into what public policymakers are thinking here? I'm thinking, for example, about things like the creation of potentially CAT savings accounts to incentivize mitigation spending and that kind of thing. What are we seeing and sort of what's in play, big picture there?
Sure. So we're seeing a number of things. One, to your point earlier, Roy, we're seeing people upgrading their building codes, which really is a foundational element that we need in terms of addressing climate change. To your point, Frank, the CAT savings accounts. So CAT savings accounts are a lot of very similar to healthcare savings accounts. So HSAs that many of us invest in for our health. And we're seeing it in Alabama, South Carolina, and Mississippi. And what these accounts do is you can invest in it tax-free. Your income generated from it is also tax-free. And then your qualified expenses, right? And these qualified expenses are deductibles that you would have normally paid out of pocket, Uninsured losses, and in Mississippi, mitigation measures as well, right? All of those are tax-free. And these are state tax-free, not federal tax-free, although there is a bill up in the federal government, the Ready Accounts Act, which would allow the same kind of tax favorability. So that's definitely a great one. We're also seeing rate frameworks that recognize or require discounts for resilience measures, and we're seeing people pick it up, and I think we'll see more of that now after this fortified homes cost-benefit analysis that has been done. So I think we're going to see more and more of that. And then the third thing I want to highlight is innovation. So in New York, NYSERDA allocated $6.5 million to innovation in insurance. And you don't think about innovation in insurance as like propelling climate change, propelling the addressing of climate change, right? But it does. It's incredible. So Insure, which is the nonprofit that handled the grant program, has recently given a bunch of grants out, and these include feedstock supply insurance, right? So it just has these ripple effects. Embedded tax credits insurances, extended warranty for electric vehicle charging stations. So it makes it easier for people to build out these electric vehicle charging stations that then has ripple effects. Embedded parametric insurance to guarantee solar radiation levels. So it makes it much more predictable for people who put in solar panels on their homes. They know that they're going to get the cost benefit works out for them, so they're more likely to do this. So these small innovations then spark things, and then they get picked up by the private sector more forcefully. So,
Thank you.
yeah.
Bryan, please.
Maybe just to follow up on that, I wasn't aware earlier, David had mentioned it from the Federal Reserve, that the CRA application with respect to resilience can be applied nationally to a local sort of event. So this notion of having a catastrophe savings account at, say, a local community bank or credit union or a national bank, with the prospect of being able to utilize some of those savings for resilience to prepare for, so to invest in their homes or businesses today and recover from, to pay the deductible in the event of some. I think there is a lot of innovation there that we can play into by bringing the banking industry's perspective on CRA to the most vulnerable through our local community banks and credit unions. So I do agree with the community development notion that came out earlier, that we are all in this together and we need to figure it out together.
Just to build upon that comment earlier about building codes, because I think we haven't really explained what we're talking about. We say the word fortified, and we talked about the Alabama example. And what are we talking about? It's about the roof. In most of these examples is a fortified roof. It's about sealing the roof deck. It's about your nailing pattern and drip edge. It's not a huge amount of cost, as Amy said. It's not a huge amount of cost. Some states, such as Connecticut, are already partway there. We already have a sealed roof deck in our codes. But it's disappointing, a lot of other states don't even have building codes. And so if we think about this, I think that is one aspect when we talk about return on investment for our communities. Improving those building codes for just those minor items is going to have a huge benefit. And it's also, I mean, when you think about the consumer side, when we're trying to explain to each consumer what fortified is, boy, that's a heavy task, isn't it? Explaining to consumers what they need to do, that's a tough task. I'd rather just tell them, trim the trees from around your house, please. Not get into, Mom, you have to seal your roof deck. What does that mean, right? That's really tough to have that conversation.
Well, there's also, I wish it were that simple, right? It's also box your eaves and 6 inches of clear. But anyway, you know,
For wildfires, much harder.
Very
yes.
complicated.
Yes.
You know, I do think it's incredibly important that we be speaking in one voice where we can to educate the property owners on what things they can do, and then what they can expect in return vis-a-vis insurance. And you know, as I said earlier, that's an evolving landscape. But right now, today, at the National Conference of Insurance Legislators interim meeting, there's a vote on a model bill that my organization has been advancing that seeks to capture the information that insurers are getting by buying drone images, right? It's aerial images that are identifying vulnerabilities in properties. And what we are looking to do through the model, and I have a feeling it's probably, it's already gotten quite a bit, I'd say, watered down, but it's still, it's a vehicle to say, okay, if an insurance company has this information, let's have them share it with the property owner. I mean, most people don't go up on their roof, so they don't know what the condition of the roof is. So if the insurer has information from these images that there's vulnerabilities, share that. So that's kind of the simple goal of this proposal, but of course the piece that's weighing it down politically is that, you know, giving people enough time to remedy it, and insurers are concerned with, well, what if the quality of the repair doesn't meet our standard? And then finally, the piece that says, and if the property owner makes the repairs, then the carrier should offer them a renewal policy if they complete the repairs before the end of the policy period. Very controversial, as it turns out. I thought it was pretty straightforward, but that's happening today. And I still say, you know, that it is in all of our interests to help property owners know where their vulnerabilities are and give them a chance. Through whatever programs we can come up with and whatever financing options we can offer, so that they actually are in a position to adapt to the way that insurers are adapting to climate change.
Thank you, Amy. I'd like to peel a couple layers back on the notion of consumer education. There is a lot there. I'm curious, what can public policymakers do, perhaps, to foster more informed consumers throughout the country? I don't know if you have any thoughts there, Bhavna. And then where does industry sort of fit into the puzzle? These are big questions, but as we step back a pace or two, perhaps we're in a time, given the threats that we face, where folks have an opportunity to appreciate their role broadly in the risk management process, and perhaps to think about the fact that pure risk transfer through insurance, that's not a panacea that will provide them full cover. Bhavna, you want to lead off there, or does anybody have a?
Sure. I mean, we can talk about consumer education again, and things like Flash that has like a buyer's guide to resilience, and improving the homeowner's resilience. And I think that's really, you know, key, disseminating the information to the consumers and getting that out there. Amy, I don't know if you want to add to.
Look, you know, disclosures, of course, regulators have struggled for years with how do we phrase it, how does it look? The NAIC has done a lot of work in this regard, and I think, you know, at the end of the day, consumers' insurance is just a very intimidating topic, and they generally rely on an agent to tell them what's up, what's what. But I do think that we've got to continue to push for much more simplified disclosures that just like, for example, one of the only people I know who carries earthquake insurance in California, the policy does not just tell me what the deductible is, but it actually puts the dollar amount that I would be responsible for of a loss before my insurance would kick in. And as painful as it is for me to see that, I think it's really important that I know that, because now I know where my gap is. At least I know, well, either I should have if I had a tax-free savings account option in California, which I don't yet, but if I did, you know, that would be a strategy I could use if I were on the ball and trying to be, you know, plan ahead.
Put insurance aside for a minute. Can we just simplify even for a minute? Where do consumers go when they buy a house? They're going to a realtor, they're going to a builder, then they're going to insurance, then they're going to a bank. And the risk signals are all different. The bank is telling you, I don't have to buy earthquake insurance. Right. Even though you're in the biggest, toughest earthquake zone there is, you don't have to buy it. And so I will give credit to the realtor industry. If you go on realtor.com, they actually have you put in your address. First Street, I think, is a foundation that provides a lot of information that at least says to you, are you high-risk earthquake? Are you high-risk flood? That's the item we have to start with to consumers, is letting them understand their risk profile to start with. Then the question is, should you buy the house in that high-risk area, right? Build a house in that high-risk area? And then what should I do for buying insurance? You know, these risk signals are very confusing to the consumers, and that's what I think we need to kind of educate better, is a unified voice to those consumers.
Yeah, and I think that there's opportunities in front of us. So Connecticut's farther along than most others in pulling these kind of elements by which, hey, what do you need for a fortified roof? How do you do this? Here's how you could get the sidecar funding to help you down that road. We don't yet have easy ways for the consumer sitting at their kitchen table to go, I just want a different outcome. If I want that different outcome, how do I get the contractor I should trust to meet a standard that you tell me makes it better, with some funding that will help me accomplish that, met by an insurance credit in my insurance product along the way? You've got to be a pretty sophisticated player to get all four of those streams to play. And so I wonder, over the next couple of years, who's going to innovate in such a way by which these pieces come together so that a consumer can say, I'm convinced I need to do the right thing. How?
I love it, Roy. Just kind of building on that, I want to commend again the insurance department for First Street. I think that tool will start the conversation from the homeowner of what are the issues I really need to be thinking about. Maybe there's a next step from there, find a contractor or something else. But secondly, one of the things we all know is that the messenger matters, right? Who do you trust? Do you trust the roofer? Do you trust your government? Do you trust the private sector insurance? Probably not. You probably trust your neighbor and your community more. So your community voices matter. And we actually see this research here in Hartford on clean energy because the city was so vocal on solar, for example. Hartford is the most equitable in terms of solar advancement in the entire country. So kind of the messengers matter, like the locality and the messengers matter in all this. But you're right, there's an innovative landscape right now. Let's leave it open to all ideas, let the markets figure it out, but let's try to get to that market transformation.
Yeah, because the consumer, I think, often ends up floating away in our innovation lake and wondering, how do I do it?
Yeah. Where's my paddle?
Yeah.
Well, it's interesting, right? Those comments sort of harken back to some opening comments that Commissioner Mays made as he kicked off the conference, talking about the fact that only by working together, can climate risk be effectively addressed. And that's essentially what I've just heard you articulate. And it's not a surprise to hear that. Our time is rapidly evaporating. It's been a fascinating conversation. Perhaps we use the last few minutes here to gaze into our collective crystal ball, as it were, and look down the road a bit. Panelists, I'm curious, if we're looking 5 years out, how will the risk and insurance ecosystem perhaps have transformed? Do you foresee significant transformation during that time period, and what might that look like? Eric, would you want to kick things off there?
Yeah, I think that we have to understand that there is an affordability gap that's going on in places in the United States. And so we have to, as an industry and as regulators and as public policymakers, evolve to think about things differently. Auto insurance, as an example, you could buy liability insurance and then you can decide, do I buy comp and collision? Why do you do that? Because it's more affordable if you can only afford the liability. In homeowners, we have this big bundled policy where you're getting building, contents, time element, ordinance and law, refrigerator, spoilage, the kitchen sink, everything's in that coverage. And the question is, should we be offering a more scaled down coverage, maybe for building only? Should there be a coverage that's instead covers your mortgage costs, or covers the value of your home? So that's one aspect. Insurance is also complicated. There has been parametric insurance that's out there that's just starting, and that's more about a trigger. If a hurricane occurs in your zip code, your policy pays out. That's it, right? And so the question is there going to be simplified approaches, maybe not the next 5 years, but over the next 10 years? And I think we, as partnership with regulators, need to think about different coverage options for our consumers.
Do you want to just go down the lightning round?
That's perfect.
Lightning round. I think we are going to continue to see more the excess and surplus not admitted market pick up more risks, which I think has some downsides for regulators and consumers in some ways, but it is what it is. I think we will be seeing, as Eric alluded to, more sort of micro products. So, where insurers are saying this risk is bigger than it was, and so we want to limit our exposure. I think we will be seeing more smaller, bite-sized coverage products, parametric, and that sort of thing. And I think that we will, I don't know, I think where the pressure on the developers is if that's gonna preventing more growth, in vulnerable areas and WUI areas is a challenge because it conflicts with the goal of increasing affordable housing. I think the insurance markets will adapt and rebound in a lot of ways. I'm hopeful, but I think consumers have they're not going to be seeing premiums go down anytime soon.
Thanks, Amy.
Such an optimistic thing to follow. And I said this a little bit earlier, I do think over the next 5 years we're going to find ways so that there's someone to lead the consumer through this journey. Mm-hmm. They need to understand the risk better. They need to understand how to address it. They need to understand how to pay for it and how that holds together. Lots of innovation are working in each of those individual streams. Over this next 5 years, we got to see that come together for the consumer.
Yeah, I think we're going to see broader use of forward-looking catastrophe models. We're going to see more climate scenarios in ORSAs. We're going to see more granular rating methodologies that reward mitigation. We're seeing it already in some places, but more and more. Expanded parametrics, certainly, and in New York we already have a parametric law that has passed, so there is parametric coverage out there. And community-based buyers, so these joint programs, and then growth in resilience finance.
Awesome. So let me take it from there on the climate finance front. So there are experts around the world who say that we need $6 trillion a year to confront of investment in our global economy to confront climate change. I think through 2023 we're at about 1.9 trillion. That's good. We're on a steady pace to where investment needs to be. But when you look at and we're actually seeing the private sector pick up more of that purse, which is good. But when you look at where the investment is going, 95% of that investment is going into the reduction of greenhouse gas emissions as opposed to adaptation and resilience, the other 5%. So we need to start moving that investment more towards the adaptation and resilience side of the equation so that we can address and protect ourselves. So I just wanted to come back to Commissioner Mays and Commissioner Mascaro-Bruno because I really gravitate to we're in it together, we're helping each other sort of message around resilience and vulnerable communities. Our vision statement as an organization is a planet protected by the love of humanity. We can't have environmentalism without humanitarianism. And what we're going to need is massive amounts of capital mobilization to help our families and businesses not only reduce these emissions, but also withstand the impacts of climate change that we're all facing. So it's great to be here today.
Panelists, thank you very much. It's been a fascinating conversation. We are out of time, but it has been wonderful. Thank you.
All right. Oh.